Good day, everyone, and welcome to the Softrax Executive Webcast. Today's conference is being recorded. At this time, for opening remarks and introductions, I would like to turn the conference over to Mr. Robert O'Connor, President and Chief Executive Officer of Softrax. Please go ahead, sir.
Thank you, Brian. I am Bob O'Connor, and I'm delighted to have you join us today. Softrax is the leading provider of revenue management solutions to hundreds of companies, many of whom join us on the webcast today. We have well over 1,000 registrants for today's webcast, which indicates how much executives want to hear about today's topic from two of our distinguished speakers from Grant Thornton, Cathy Hyodo and Mike Schamberger. Cathy and Mike will share their presentation on writing, play on words there, so you have to look at the screen, the revenue recognition policy. We have good national coverage. Cathy joins us from San Diego, Mike from Chicago, and I'm in Boston. Our audience consists of CEOs, CFOs, board members, venture capitalists, VPs, accountants, and other corporate and financial professionals. Let me just take a minute to take you through the agenda. I'll spend a few words on Softrax revenue management, and then I'll turn it over to Cathy first, and then to Mike, who will spend most of the webcast talking about their topic of the revenue recognition policy and the topics that you see on your screen. For those of you who are familiar with our webcast, you'll know that a very important aspect of our webcast is the Q&A. For about the last 10 or 15 minutes, up until the top of the hour, we'll devote to Q&A. And don't be discouraged by the number of attendees. We need questions, so ask away, and I will make sure that as many questions as possible get addressed towards the end of the webcast. And I'll be reading these questions throughout, and just for some instructions, you'll see the question box on your slide, and please ask a question. It's in the lower left-hand corner of your webcast console. Ask a question. I'll be reading that as Cathy and Mike speak, and I will be asking them as we go. The most often asked question is, can I get a copy of the slides? And the answer is yes, but we do make you work a little for that. Upon conclusion of the webcast, your browser will be automatically redirected to an online survey page, and we ask for your feedback. This particular program is a result of many of your feedback who want to talk about revenue recognition policies. And you also note that please make sure that you have any pop-up blockers turned off so that you can receive the survey page. And as a result of that, you'll get the presentation slides. You'll also get a bonus survey report. It's Grant Thornton Survey of U.S. Business Leaders, their 12th edition. Very much worth reading. So please give us your feedback. That benefits us. You'll get a copy of the slides, and you'll also get a copy of that report that I just mentioned. A few words on Softrax revenue management. We are pleased to know that customers manage billions of dollars of their revenue using our products. And throughout the U.S. and throughout the world, hundreds of companies in many different industries use our products to manage their revenue, their billing, their revenue recognition, reporting, and forecasting. As you may know, Softrax started out by serving software companies and is the leader in that industry by far. And as you can see from the slide below, we have grown to serve many different industries. Sarbanes-Oxley is driving a lot of this, and as you can see here, that over 50% of public companies and almost the same amount of private companies have changed their revenue recognition policies as a result of Sarbanes-Oxley. And from the point of view of what areas are the most difficult to control or to establish internal controls, not surprisingly, revenue recognition accounting and contract management are two of the areas that have the greatest difficulty in terms of areas to control. It's not a surprise to us, nor to many of the people on the call or the accountants in the world. And we solve these two areas, or aim to solve these two areas for our customers. CFOs of public and private companies do not lack for challenges in today's environment. They have plenty of operational challenges, working with their business model, managing contracts, many different types of revenue sources, whether they're licenses or subscriptions or transaction-based or on-demand models. They also need to comply with both revenue recognition issues and other compliance measures. We've mentioned Sarbanes-Oxley, but all of the revenue recognition issues that continue to be updated and continue to make things much more complicated for financial people in your industries. And lastly, CFOs are dealing with visibility and transparency issues about financial reporting and the details of financial reporting and visibility, revenue forecasting, and other financial forecasting. And our solutions closely align with these challenges and provide the following value propositions. We aim to improve operational efficiencies and increase the revenues of our customers. We want to enable the management of complex revenue and expense accounting that support the compliance issues that you have to deal with depending upon the industry that you're in. And lastly, we want to enhance business performance and allow you to get real strategic value from visibility into your current, past, and future performances. And our products align closely with these initiatives as well. Our billing and operations applications help you manage contracts with your customers, complex billing, contract renewals, order processing, and so forth. We have very deep functionality, the deepest of anywhere in terms of revenue and expense accounting that allow for allocation, scheduling, recognition, specific issues like BSOE and other revenue recognition issues, as well as expense accounting. And lastly, business intelligence applications that, again, help you with transparency, strategic information about your revenue, and allow you to forecast accordingly. And all of these products can be licensed individually or as part of a suite application. And they are supported by complementary applications from time and expense to financials and other applications. We are pleased that our customers report strong value from the use of our products and our services. Customers report greatly improved compliance with Sarbanes-Oxley and, again, these revenue recognition guidelines. They also report a great deal of efficiency, whether that efficiency has to deal with how they manage their contracts, their revenue, their maintenance renewals or billing, and also improved customer relationships. So our goal is to help our customers increase revenue, become more operationally efficient, decrease their costs, and comply with the requirements. Our customers view the work that they're doing and we're doing as not only complying but also helping them with operational efficiencies and helping them to drive revenue. So with that, I will introduce our speakers. First, a moment about Grant Thornton. They are a leading global accounting and tax advisory and business advisory firm to both public and private companies with 50 offices across the U.S. and almost 400 offices in 84 countries. They help their customers comply with requirements of Sarbanes-Oxley and help them improve the effectiveness of their governance, risk management, and information technology processing. Now, as I said earlier, our speakers are Cathy Hyodo and Mike Schamberger. Both of these speakers bring a great deal of experience to share with us today. Cathy has over 12 years of experience in public accounting, providing clients with accounting, auditing, SEC, business advisory services to many different types of clients, including technology, manufacturing, and financial institutions. She has extensive experience with public companies and all of their filings. For a while, during the dot-com era, she worked as the manager of financial reporting for a public internet company. And so we're delighted to have Cathy join us today. And second on our agenda is Mike Schamberger. He's a partner with Grant Thornton and mostly focuses on serving early stages, middle market, private, and public companies, including industries such as telecommunications, software, hardware, internet, IT, consulting services, and biotech. Mike leads the technology industry practice in Chicago and is one of 6 members of their national technology industry practice leadership. So again, we are delighted to have both Cathy and Mike here today. I welcome them and thank them for their participation, and I'll turn the meeting over to Cathy.
Thank you, Bob. Good morning to all of you. As we begin, for most companies, as you know, revenue usually is the largest single line item in the financial statement. Issues involving revenue recognition are among the most important and difficult that standard setters and accountants deal with regularly. According to the FASB, revenue recognition is a primary source of restatements due to the application errors and fraud. Those restatements decrease investors' confidence in financial reporting. The FASB is currently pursuing a revenue recognition approach that is based on changes in assets and liabilities. They have been and continue to work on a project to develop coherent conceptual guidance for revenue recognition and a comprehensive statement on revenue recognition that would be based on those concepts. Because revenue recognition continues to be a critical component of financial reporting, especially for technology businesses, there has been ample focus on the controls and processes surrounding the recognition of revenue under the scrutiny of Sarbanes-Oxley. A study published on November 21st, 2005, conducted by RevenueRecognition.com in association with International Data Corporation, or IDC, reported that more than 55% of all public companies have indicated that they have changed revenue recognition policies and practices as a result of Sarbanes-Oxley, as Bob previously mentioned. A quarter of these changes are rated moderate or significant. But Sarbanes-Oxley is not the key driver and the only driver for the policy changes. Business model changes are having even more of an impact on revenue recognition, especially in technology companies. As an auditor of technology companies, there are a number of red flags that are identified during our audits. Communication between the sales, marketing, legal, and accounting and finance departments are imperative to ensure that products or services provided to customers are captured in its entirety and that appropriate accounting treatment are applied. The lack of communication leads to concerns regarding not only the inappropriate accounting for existing contracts, but also the lack of accounting for a transaction if it occurred. Also, operationally, business models and or accounting policies could be changed based on an understanding of the accounting treatment. The governance and process control surrounding contract agreements entered into by international locations, especially within a software company, is an area of high risk. Doing business in international locations need to be monitored and then understood by the corporate offices, as the business culture may be dramatically different. For instance, doing business in emerging countries tend to be less structured and less formal, which would require companies to have controls in place to ensure all transactions are captured. Not only does the lack of standard contracts increase the risk of the audit as well as the scope, it requires more time, expertise, and resources by internal financial and accounting departments to ensure that each agreement is accounted for appropriately. With a significant number of customization of contract agreements comes an increased risk of error with regards to the application of the appropriate accounting literature to the specific agreement. For all companies, not just technology companies, the tone at the top continues to be one of the most important and effective controls when operating effectively. As auditors, we've become very concerned when board members lack sufficient knowledge of the risk areas in the revenue process, as well as a good understanding of the potential areas for fraud and misstatement. The lack of understanding by accounting and finance personnel goes back to my previous mention of lack of communication as well between departments. There are over 200 pronouncements by various standard-setting bodies that's hard to retrieve and sometimes inconsistent with regards to revenue recognition. We have seen many instances where the product development and sales force does not inform the accounting and finance personnel as to what is actually sold or delivered to the customer. The lack of understanding of all products delivered and benefits received by the customer could lead to the inappropriate recognition of revenue. Because the technology industry is constantly changing, as well as the business models, we often see the lack of sufficient resources within the accounting and finance department. Technology companies often enter into complex transaction agreements with customers, which creates the need for a higher level of expertise and understanding of the application of the appropriate accounting literature. Additionally, the number of customized agreements as well as numerous deliverables to a customer within one agreement increases the amount of effort spent by internal finance and accounting personnel to track and account for each aspect. Side agreements are often difficult to audit and are usually discovered through interviews conducted by audit team members with individuals outside the accounting and finance function. These would include discussions with sales representatives, marketing department personnel, as well as even CEOs and or COOs. Historically, side agreements have resulted in multiple restatements of financials. Side agreements tend to alter the nature of contractual promises and related unconditional rights and obligations. Generally, issues with side agreements are due to breakdown in internal controls rather than just the lack of the accounting guidance. As business models evolve or emerge, selecting the appropriate and identifying the appropriate literature becomes more difficult because much of the existing guidance is transaction-specific or even industry-specific. The following is a list of some of the key accounting guidance for technology companies. Staff Accounting Bulletin 101 was released back in December 1999 and provides the staff's views in applying generally accepted accounting principles to selected revenue recognition issues. Although not industry-specific, the guidance answers questions regarding specific transactions, such as transfer of title, substantial performance acceptance, non-refundable payments, accounting for certain costs of revenue, refundable fees for service, estimates and changes in estimates, and fixed or determinable fees. SAB 101 identifies 4 essential criteria that should be met before product revenue can be recognized. SAB 104, issued in December of 2003, revised or rescinds portions of the interpretive guidance of Topic 13, which is described under SAB 101, in order to make the guidance consistent with current authoritative accounting and auditing guidance and consistent with SEC rules and regulations. Accounting requirements for revenue recognition for software companies contained in Statement of Positions 97-2, as amended by SOP 98-9, are rigorous and very specific. Each element of a software transaction has to satisfy all revenue recognition criterion in SOP 97-2 before revenue for that element can be recognized. Complicating the situation are the complex transactions software companies sometimes enter into, which may combine licensing arrangements, installation, and or training services, obligation to deliver software not yet available, and customer support. Applying the extensive and rigorous accounting guidance to complex bundled software arrangements requires an understanding of the product and in-depth knowledge of the accounting requirements and judgment. The interaction of pressure to meet revenue targets, complex accounting rules, and multiple element contracts appears to have contributed to the financial statement restatements in the software industry. BITF 00-21 discusses a reasoned method of accounting for multiple element arrangements that is applied consistently and disclosed appropriately. This literature addresses how to determine whether an arrangement with multiple deliverables contains more than one unit of accounting, and if so, how the arrangement consideration should be measured and allocated to the separate units of accounting. It applies to all deliverables within contractually binding arrangements in all industries, under which a vendor would perform multiple revenue-generating activities with some limited exceptions. With regards to EITF 03-5, the issue is whether non-software deliverables included in an arrangement that contains software that is more than incidental to the products or services as a whole are included within the scope back to 97-2 software revenue recognition. In an arrangement that includes software that is more than incidental to the products or services as a whole, software and software-related elements are included within that scope. For instance, in an arrangement that includes software, computer hardware that will contain the software and additional unrelated equipment, if the software is essential to the functionality of the hardware would be considered software-related and therefore included within the scope. However, because the software is not essential to the functionality of any unrelated equipment within this example, the equipment would not be considered software-related and therefore would be excluded. SOP 8011 is applicable to software companies in that if an arrangement to deliver software or a software system either alone or together with other products or services requires significant production, modification, or customization of software, the entire arrangement could be accounted for in conformity with long-term construction-type contracts in conjunction with 97-2 software revenue recognition. Let's look at some accounting issues that's been identified. As described previously as part of EITF 03-5, it's sometimes difficult for a company to determine whether the software is essential to a hardware's functionality. If the conclusion is that the software is more than incidental, then the company must follow the appropriate guidance. The industry is becoming increasingly competitive, giving customers the ability to negotiate volume discounts, package deals, rebates, price concessions, and even extended payment terms. All of these factors can affect the company's ability to determine the vendor's specific objective evidence of the fair value of each element in an arrangement and whether the arrangement fee is fixed and determinable. Both VSOE and a fixed and determinable fee are prerequisites for recognizing revenue on multiple element arrangements. Similar to determining how to determine VSOE to multiple deliverables and account for them, the same holds true for discounts received by the customers. Same is true on the allocation of the discounts to the bundled deliverables. Software licensing arrangements are routinely sold together with services as maintenance, installation, and training. 97-2 has additional special requirements that have to be met to recognize revenue associated with services separately from other elements of arrangement. As software becomes more complex, for example, entity-wide applications, the service elements in software arrangements often become more significant. This can complicate judgments about appropriate revenue recognition for the arrangement. If the services are essential to the functionality of the software, the arrangement should be accounted for using contract accounting. The services do not qualify for reporting as a separate element, and the services are only undeliverable item under the contract. The entire contract fee should be recognized over a service period. Those responsible for financial reporting and auditors need to give special scrutiny to contracts with significant service elements to ensure that revenue on those contracts is not recognized prematurely. EITF 99-19, called Reporting Revenue Gross as Principal versus Net, indicates that diversity exists regarding whether a company should report revenue based on gross amount billed to customers because it's earned the revenue from the sale of goods or services, or the net amount retained because it has earned a commission or a fee. The issue often arises with companies that sell goods or services over the Internet. Many of those companies do not stock inventory and may arrange for third-party suppliers to drop ship merchandise on their behalf. Those companies also may offer services that will be provided by a third-party servicer. However, the issue is not limited to companies that sell products or services just over the Internet. Issues may arise in, but not limited to, transactions related to advertisements, mailing lists, event tickets, travel tickets, auctions, magazine subscription brokers, catalogs, consignments, special retail orders, or even resellers of software and hardware. How companies report revenue for the goods and services they offer has become an increasingly important issue because some investors may value certain companies on a multiple of revenues rather than a multiple of gross profit or earnings. Net income generally does not differ based on whether a company reports revenue on the gross amount or billed to the customer or the net amount retained. Gross versus net representation could change in any given year of a company's business, depending on whether there is significant and material change in the company's business model. A company could shift from gross to net and vice versa. Side agreements, which may relate, for example, to a delivery, customer acceptance, or evidence of arrangement, can affect the timing of revenue recognition. Written policies should prohibit unauthorized side agreements between sales personnel and customers. However, even if such policy exists, those responsible for financial reporting and auditors should make inquiries to establish whether there are side agreements. Such agreements can introduce contingent provisions that delay revenue recognition until such items are resolved. Failure to discover side agreements and take them into consideration can result in improper revenue recognition and possibly restatement. Translation of contract arrangements refers to companies with multiple international locations and sales. Incorrect accounting has been identified in the inaccurate translation of international contract arrangements. Arrangements with international customers often vary from contracts within the United States. Accurate translation of international arrangements is critical to determine the appropriate accounting treatment and identification of all items, such as multiple elements, discounts, maintenance, etc. There are a number of accounting considerations related to third-party resellers. For instance, price protection clauses within an agreement protects the reseller if a vendor reduces its price when the reseller still has a product in inventory. Such provision requires the vendor to refund or credit a portion of the original fee if prices are reduced. If a vendor cannot estimate future price reductions because of competitive conditions, or if there's uncertainty whether a vendor can maintain its price, the fee is not fixed or determinable. The entity would then therefore defer revenue recognition until it can estimate the effects of future price changes and other revenue recognition criteria are satisfied. Setting a tone that promotes ethical conduct that permeates the corporate culture is key to have the tone at the top. Such an environment would ideally deter misconduct before it takes place rather than punishing it after the damage has been done. A major determinant of such a proactive, ethical, strong environment is strong, high-quality leadership provided by senior executives. With technology being such a highly competitive industry and a continued pressure to meet earnings targets set by public markets, the tone at the top is key to prevent fraud and material misstatements. Inherent risk increases as a company lacks the use of standardization of contracts. Accounting and finance personnel departments would spend significant amounts of time reading through each contract and accounting for each element. Although it's impractical to have 100% standard contracts, by attempting to standardize the majority of contracts dramatically decreases the risk. The control surrounding such contract arrangements and changes when a contract is completed and approved is important. To be documented and approved by appropriate persons is a critical component. To avoid unexpected revenue deferral resulting from terms of sales contracts, financial reporting managers, and legal personnel should coordinate with sales and marketing personnel so that the accounting implications of complex arrangements are known when the contracts are entered into. Controls would include monthly meetings as well as the use of matrices or even dashboards. Hand in hand with open lines of communication between departments is in the training of sales personnel. Lack of understanding by sales personnel puts a company in detective mode rather than implementation of preventative controls to ensure that agreements entered into by sales personnel are consistent with companies' operating goals. Revenue recognition for technology companies, and specifically software companies, is, again, restrictive and complex. Those involved with financial reporting at these companies need to develop the requisite skills and expertise and begin with a thorough understanding with the provisions of the SOP 97.2 and limited modifications of its requirements in 98.9. With international sales and operating locations of companies, required close monitoring of business units, especially of those in emerging markets. Cultural differences, as well as operational differences, will cause significant accounting implications and inconsistency within an organization. At an activity level, key controls should be identified and maintained at the contract revenue and change process. Documented controls are important when evidencing approval for changes of contracts and or customization of language within an agreement. Review should be evidenced not only by legal but the accounting and finance department as well in order to prevent unwanted accounting implications. Controls within the journal entry process are important to maintain the appropriate accounting treatment for revenue items. Risk level increases when there are significant manual journal entries, which are inherent within a technology company with numerous non-standard contracts. Understanding these manual entries as well as documented approval of these entries is critical to prevent fraud and misstatement of financial information. Controls within the job costing process is important for those technology companies that are service providers. Margins could be materially misstated should the control surrounding allocation of time by employees to projects is not appropriately captured. Entity-level contract-related adjustments should be rare, but when this occurs, documentation and controls surrounding the approval of such adjustments is key to prevent misstatement of revenue. Companies that have significant contract-related adjustments pose a higher risk of material misstatement and would require a substantial amount of preventative and deductive controls in place to reduce this risk. Mike will now discuss how to construct a revenue recognition policy.
So, Mike, before you begin, if I could, I just want to remind the audience that if you'd like to ask a question, please ask a question, submit the question through your Ask the Question feature located in the left-hand corner of your webcast console, and I'll be reading them. I already have been, and there's certainly room for many more. And there will be instructions at the end of the webcast about availability of the slides and other information. So for those people who joined us late, please hang on to the end for those announcements. Mike?
Thanks, Bob. Good morning, everyone. Good morning to some, and good afternoon to others. Basically, what I'm going to be discussing today is how to construct your revenue recognition policy, including the revenue recognition policy document itself, how to ensure your policies are sufficient, best practice to continually evaluate and update your revenue recognition policies, when to involve your auditors in the process, and basically what they can provide to the company, and also how this all ties into what we all love, SOX 404. So first of all, constructing the revenue recognition policy, this basically is really more of a common sense type of item. It's not really much different than creating policies and procedures for other areas of your business. However, this process is not easy. It is a significant undertaking, and it's going to require much time and effort in order to complete it. First thing what you should do is you should gather the CFO, the controller, and the revenue accountants to basically review the business models, the product lines, service lines that are throughout the organization. Basically what this is, it's a brainstorming effort coming up with, within each business model, the product lines and service lines to make sure that all these revenue streams and all the revenue streams associated with the company are identified. These can include such things as software, services, the maintenance piece, value-added resellers. Could also include application hosting, third-party software that the company is selling, and also can include financing arrangements that you're entering into with client customers, leasing arrangements, and once in a while and very rarely, barter transactions. Once each business model and product line, service line has been identified and the revenue streams associated with it, you need to document each revenue stream. Once it's documented, you need to understand and document the next item, which would be the appropriate revenue recognition and the treatment for each revenue stream identified. As Cathy has already discussed, this includes under SAB 101 and 104, specifically SOP 97-2, SOP 98-9, EITF 0021, EITF 03-5, SOP 81-1, and also EITF 99-19. So once an understanding has been made about the appropriate revenue recognition treatment for each revenue stream identified, next you want to draft the revenue recognition policy memo. Normally what I've seen in practice is there's a summary in connection with each policy. The summary kind of goes through a basic description of the policy, the applicable accounting literature, a description of each revenue stream, kind of at a high-level basis, and also what time period the policy relates to. And generally what we've seen in practice is the policy is generally good for a year before it's updated. And specifically, the policy is going to discuss each revenue stream. It's going to have a detailed description of each revenue stream, what it is, the specific applicable accounting literature and how it is to be applied in each area, description of non-standard contracts, agreements, and elements for proper accounting treatment. And also I've seen examples of calculations. I've also seen examples of flowcharts to help with difficult revenue recognition issues. Next, how to ensure your policies are sufficient. After the revenue recognition policy has been drafted, the CFO, the controller, and the revenue accountant are basically come and meet once again just to make sure that all the revenue streams have been identified. Has the appropriate revenue recognition been documented for each revenue stream? Is it in sufficient detail? Are there any revenue recognition streams or revenue streams where the accounting is not in accordance with the proper revenue recognition pronouncement? Hopefully that's not the case for everybody out there. And once again, once it's all finalized, have the appropriate level of management approve the document. Actually have the CFO, have the controller sign the document. What are the best practices to continually evaluate and update your revenue recognition policies? If there have been no significant changes in the business, i.e. such as if there's no new products, no new services, or acquisitions that have taken place during the year, then we've only seen an evaluation and an update on an annual basis. And basically what the evaluation and update on an annual basis concerns is going through the same exercise as a construction phase. The CFO, the revenue accountants, the controller getting together, making sure that they've identified all the revenue streams and documenting as such. If there are new and significant product service lines, you'd want to evaluate and update at each quarter perhaps. If there are small changes within revenue recognition or small changes within new product service lines, I've seen addendums actually attached to the policy, and then once again the addendum signed by the appropriate level of management, generally the CFO and the controller. If an acquisition occurs, you want to obtain the acquisition company's revenue recognition policy and integrate those items within your own revenue recognition policies if they're different. You also obviously want to take a look at any acquired company revenue streams to make sure that those revenues are being recognized properly. Once again, after the evaluation and update, the policy is then reapproved and signed by the CFO and the controller. Now, a lot of you are asking your questions, when should I get my auditors involved? And really, what can they provide me during this whole process? Well, I would say involve your auditors right from the beginning. Include the auditors in the meetings that identify the business models and revenue streams. You can invite them to the kickoff meeting, and basically in just a view process. This helps for the auditors to understand the internal controls of the company and also helps in the SOX 404 documentation. You can also have the auditors review the appropriate revenue recognition that the company identifies to see if they agree. If they don't agree, why don't they agree, and ask for direction as far as where the applicable accounting literature is. And you can also have the auditors review a draft of the revenue recognition policy and provide comments. A lot of you are asking yourselves out there, well, wait a second, my auditors already have documented all our revenue streams, the business processes, and also the applicable accounting literature. Why can't I just ask them for that particular, for their memos to include within the company policy? Well, we're not allowed to provide those particular memos that we draft for the work papers, because then it would be viewed that the auditors drafted the revenue policy for the company. But like I stated before, the auditors can review and are involved somewhat in the process during the drafting process to provide constructive comments. We usually generally do provide good comments because we've seen many revenue recognition policies out there and have helped clients through that process. Last item is relating to the tie-in to SOX 404. Basically, you need to document the process of developing and updating the company's revenue recognition policy as part of the internal controls. Make sure the policy follows the identification of significant processes within the business models and the revenue streams. The policy is to be forwarded to the auditors each year for SOX 404 audit as part of the integrated audit approach. And remember also to forward a copy of the policy to the audit committee. With that, that concludes my presentation. Bob, if you want to take it over.
Absolutely. So we have lots of questions, and I thought we'd go to Cathy first and give you a little break, Mike. So, Cathy, there were a lot of questions about, at one point you talked about products that were incidental, that had an incidental amount of software, and I think that got people going in terms of that. So this is kind of a combination of multiple questions, but certainly many different products out in the marketplace have some type of software element to them. And in one question, they even mentioned iPods. And so you mentioned incidental. How do you decide whether something is incidental, and therefore how do you decide whether this is a 97.2 issue or EITF 0305 issue?
Obviously, many products out there do have software attached to them, such as iPods and other MPA equipment, things like that. You really need to take a look at the product itself and determine, can this be standalone and operate without that software product? You also have to determine the cost of the software that was that it cost the company to develop that software that has been attached and included with that hardware component. Could that software also be used outside of that hardware component is another determinant. It's not, a hard, fast line where I can give you an answer that if it's this, then you would say it's incidental or not. It really depends on the business and what's the product you're trying to sell. And it's not a complete answer, but it's really specific with regards to your actual product. Many of the products do have incidental software. However, when you're selling large pieces of hardware, iPods, the software could it run separately and on its own, depending on how much that costs, depending how much the functionality has to do with the software, a determination internally with regards to that cost, and will need to be made by a company.
Okay, there was certainly any time anybody starts talking about side agreements, that gets a lot of interest.
Yes.
There were several questions about, and I can shed some light on what we do once you finish, or if Mike wants to weigh in as well, about side agreements. Are there any best practices for identifying them and certainly managing the sales force so they don't happen? Is there
right. As I mentioned in my presentation, some of the most important controls in place in a company is to have preventative controls in place with regards to side agreement. Some of those best practices, per se, are like having monthly meetings, and I've seen companies have monthly or quarterly meetings with the sales force, accounting force, and legal groups to understand all the agreements that are being entered into and to understand the products and deliverables that are being sold to customers, as well as what the sales force is out there selling to the customers. Just by hearing some of those actions by the sales force, accountants and financial experts within the organization can identify whether side agreements exist. Some companies actually have actual signed documents that they hand to the sales force and ask whether any side agreements have been entered into, and they give examples based on their industry. Preventative controls are the key to identifying side agreements. If, at this point you're starting your control process, immediately talk with the sales force and the marketing people and determine what have they described or have sold to the customer. Just by communication is a key aspect of identifying side agreements.
I've also seen instances where our clients would communicate, the finance team would communicate directly with the customers to see if there's any side agreements, kind of a confirmation that there are no side agreements exist. And then also you'll see the auditors do that too. They'll create a confirmation, a contract confirmation asking for specifics. And also one of the questions that is asked is, are there any side agreements and do they exist? And if so, what are they?
And we do all that as well, and our CFO has quite a big hammer and says that any side agreements are grounds for immediate termination. And so that's one way to, as well, we have not had to enforce that, thank goodness, but we have made that policy and also many of the preventive issues that you mentioned as well. We've got a lot of questions about resources on both sides of these discussions, and let's start on the Rev Rec side first, Cathy. Where does someone go? There's an overwhelming amount of information out there. Where do they look for access to and repeated access to Rev Rec guidelines? Let me start with that question, then there's a follow-up about training.
Well, there are a number of areas or places you can look to. Obviously, for some smaller companies, it would be very costly and expensive for them to get licenses to accounting software and literature. But there are a number of free areas you can go to, such as the SEC.gov, or FASB.org, those websites that are the writers and the individuals who are releasing the pronouncements. Even if you go to FASB.org and just put in revenue recognition, it will immediately pop up the board's discussions and the current concerns regarding revenue recognition and identify their areas that they are working on to rewrite the revenue recognition policy, as well as identify certain areas of specific concern to them. So there are a number of free websites that you can go to, as well as just open discussions with your public auditor, your public accountants. They usually have internal documentation that can be released. They're not giving you guidance per se on a specific transaction, as that would impair independence, but have standard releases within a firm as to application of revenue recognition that could be specific to a software company or to a technology hardware-based company. So many of the firms have released literature on revenue recognition issues as well.
And the second question to that goes to training, and I'll answer the first part. Specific training. Softrax sponsors conferences that are by a separate organization called Executive Enterprises, and they have conferences throughout the country. You can get those at www.eiconferences.com. Do either of you know of any other additional real training, detailed training on revenue recognition issues, BSOE, and so forth?
You can go onto the AICPA website and find training that the AICPA provides. Also, if you have a good relationship with your auditors, what you can also do is, since the auditing firms go through their internal training, you can maybe ask the auditors to come out for spend a couple hours, 3 hours, 4 hours, and step you through their revenue recognition training. I know I've had a couple clients ask me, can I provide a revenue recognition training course for them? And basically what I do is I just take what we normally give internally and then go out to the clients and provide that to them.
We have several questions around undelivered elements, as you'd imagine, and some good questions about what can you do and what can't you do, and when do you cross the line, such as customers might ask in an RFP, they might ask for future roadmaps, product roadmaps, plans for products, things like that. And when is that a roadmap, and when is that a commitment towards a specific deliverable that might have you defer revenue? Either of you have any thoughts on that? No? Neither.
Repeat the question.
The point, Mike, here is that in many cases, technology companies have to provide insight to their prospects about the future, and they might ask a question. We get these questions all the time about, where's the product going, and give me some information about that. And to depending upon how you provide that, will it be construed as by accountants as an undelivered element or a future commitment that might defer revenue versus you're buying the product as it is today, and this is what we plan to do.
Okay. Yeah. Generally, within the maintenance agreement, you'll see unspecified updates. So basically, when you acquire the software, part of the software acquisition is going to be a maintenance agreement, and then that maintenance agreement will be entered into on an annual basis thereafter. So whenever there's updates to that particular software, generally the maintenance agreement covers that. But in the initial agreement, if there is a specific upgrade that a customer wants, or for purposes, let's say the salesman says, well, look, we have version 1 out right now, but version 2, 3, 2 and 3 are on the table, and we'll make sure we get this to you. That could be identified as a specific upgrade, and therefore it could have some significant revenue recognition issues associated with that.
Okay, back to your presentation, Mike. Some good questions about people who are developing Rev Rec policies, and two questions specifically. What reasonable timeline do you think that would take for some people? And secondly, again, back to the resource question of before, are there copies out there anywhere of Rev Rec policies that people can look at? Hopefully not copy, but look at for substance and for consideration as they develop their own.
Yeah, but from the first question, as it relates to a timeline, it really depends upon how many revenue streams the company has, and the complexity of those revenue streams. I mean, it could be anywhere from a week to a number of months in order to really sit down, identify, develop a discussion, identify the appropriate accounting and treatment, and then also create the document itself. If there are multiple countries, if there's multiple subsidiaries and segments of the industry, of the company, obviously it'll take longer to identify and spread all those out, and therefore take much longer. So really, it's on a case-by-case basis. As it relates to the resources, I don't know specifically of any place out there where you can get a copy or kind of a cut and paste type of policy. But what you probably can do is call your accountants, call your auditors to see if they can provide some help as far as what the policy would look like. And generally what I've done in the past is I may take a couple clients of mine and then redact their names on the policy and redact any information that may lead to my particular customer. It kind of gives them an outline as far as how to draft the policy.
Yeah, I think that's what they're looking for. That would be certainly helpful.
And Grant Thornton does have a group, a business advisory services group, that can help companies draft and develop their revenue key controls within their revenue process. And as long as they're not the external auditors, obviously, we do have special consulting groups that actually would help companies draft revenue policies as well as implement and identify key controls and set them in place for early-stage companies as well.
Okay. Back to some more Rev Rec questions. Certainly one thing that people struggle with is if you're selling something to a certain customer and there are multiple contracts to that customer, is there a time limit between transactions or between contracts that is considered to be the same agreement and therefore would be governed under the terms of one agreement? Does that question make sense to you?
Yeah, I can take this one. Generally, if separate contracts are being negotiated all at the same time, the revenue recognition requirements is that you really don't have separate contracts. Maybe from a legal perspective you do. But from an accounting perspective, since they're all being negotiated at the same time, it's really taking a look at all those contracts into one and determining what the proper revenue recognition is. There's also instances where one division is negotiating a contract, and then there's another division within the same company negotiating a different contract, maybe with a different division of the same customer. There's some instances where you would still bring those two together. There's other instances where you would actually look at those separately. It's really on a case-by-case basis from that perspective. As far as a time frame, as long as the two or three contracts are being negotiated separately, if they're running parallel timelines or they're very close to being signed all at the same time, then you would basically call them all together. But if there's maybe three or 4 months generally between the negotiation of the contracts, then there is some guidance stating that you can separate those from a Rev Rec policy. It's really you can't point to the literature and say, okay, it's 90 days, okay, it's 6 months, okay, it's 30 days. It's really on a case-by-case basis. What is the company doing? What is selling? What do the contracts consist of? What salespeople are involved in the sales cycle? Who can approve it from both the customer standpoint and also from the company's standpoint, that particular contract. So there's many variables you take a look at to determine whether those contracts need to be viewed as one for revenue rec policies.
We deal with a lot of customers who wonder how much of the related expenses they should be deferring, expenses that are related to the revenue that they are deferring. And their business model might be on a subscription basis, a recurring basis, as many of our customers do today. And they wonder about the expenses, the direct expenses that are affiliated with the revenue. And do they charge those expenses up front, or do they defer them over time? And I know there's no black or white answer, but could either of you comment on how someone could get their arms around whether they should be doing that or not?
I'm sorry, Bob. I apologize. Can you repeat that one more time?
Yeah, the question has to do with matching expenses, deferring expenses that are related to revenue that was deferred. And do you see your customers doing that, or is there any thoughts on how a company who does have a model where they defer revenue and recognize it over time and has direct costs, might be third-party royalties, might be sales commissions, things like that. So, again, more about on the advice about how they might get to understanding whether or not they should be doing that.
Well, I guess it really depends on when you talk about that. It's very specific with regards to you got to look at the business model and really what they're selling, and also the cost incurred with that. Obviously, when you say deferring, from an auditor perspective, it gives us a little comfort to know that the company is looking in a sometimes called a more conservative approach. However, companies could be inappropriately deferring revenue and then bringing them back in later on. But you really need to match it up. It goes back to the standard accounting principles of matching the costs associated with the revenues. And if a company is deferring costs because they are being incurred as the deliverable is being delivered to the customer, then it would absolutely be appropriate to defer that revenue in that instance. You really need to take a look at is what is being delivered to the customer. Sometimes it's very difficult to determine what the customer is receiving. And so what is the real benefit to the customer and what are ancillary items that aren't beneficial to them. So costs associated with that should be matched up appropriately.
Mm-hmm. In terms of granularity of revenue recognition, certainly there's been a lot of issues in the market about this. Do you recommend, or do you see most of your customers recognizing on daily or weekly or monthly basis?
I've seen most of my clients are recognizing on a monthly basis. Yeah.
Right.
We've certainly seen in our customer base, again, because our software accommodates it, that might be the case, is that people want to get down to the granular level of daily, and certainly there was a public company who has issues with that, so that's we do see some of that.
Well, as I previously mentioned, many companies already have difficulty obtaining the necessary resources, within a technology company right now to even account for a number of these unusual transactions. And to go down to a granular daily and even a weekly would take even more internal resources to do that. Monthly is where I see most of the companies, and it's absolutely acceptable on a monthly basis. Yeah,
and that also ties into the monthly financial statements that are put together and flash reports that are pushed to management, just to make sure, if you had it on a monthly basis, then you're properly recognizing the revenues.
A lot of questions, as we frequently get, about the costs of compliance, not surprisingly. And certainly we hear a lot from our customers who are automating systems, especially around revenue, to make sure that they have a repeatable model and one that is affordable on a go-forward basis. Can either of you comment on the concerns that people have out there in terms of what they are spending to comply, or what might be happening in the marketplace around automation, or in addition to automation, to reduce some of these compliance costs, or is that not even possible?
Well, the cost factor is one that's, particularly as it relates to the accelerated filers and the SOX requirements, and basically the auditors coming in and now having a full integrated audit, which in some instances almost doubles the audit fee. From a cost perspective, I mean, the way the environment is now is that companies out there need to document their internal controls, understand their revenue streams, making sure that all the revenue is being accounted for properly. And it's all documented appropriately. It's all signed off by the appropriate level of management, and unfortunately, that's a heavy burden on a lot of companies, and a heavy burden from a cost perspective. But right now, that's what the market is demanding. I think as we move on, particularly for the accelerated filers, as we move on to years 2, 3, and 4 of SOX 404, you'll probably see those, or hopefully you'll see those costs being declined from an internal standpoint and also from an external standpoint, from the auditor's standpoint. Everybody's has gained an understanding of specifically what SOX 404 is. Kind of the first year was let's throw everything up there and identify it as a critical cycle. Second year we saw basically the peeling back of what is identified as a critical cycle, what needs to be documented and what needs to be tested, and I think that will continue on for a little bit, a couple of years here until it starts flattening out.
Right. Where I see the cost continue to not increase but be maintained at some high levels is when there's dramatic changes in the business of a company, and as technology evolves and business processes change, and even just the business itself change and the product changes, the accounting for the revenue recognition process and cycle continually has to be reviewed and updated by a company. And they need help, such as with Softrax and other software items that are easily, can easily be switched to address those issues based on the different types of products that they're getting into.
And can either of you comment on the FASB's, kind of what's coming, kind of a little bit view in the future in terms of what people might be concerned with respect to things that FASB is working on for this audience? And maybe even some issues about convergence of issues regarding U.S. GAAP and international.
Yeah, I think over the next few years you're going to see a convergence of the U.S. GAAP and other international, mostly Western companies and their revenue recognition policies, revenue recognition pronouncements. So you'll see it coming together, not only from the rev side, but also we're already seeing it in other areas of the accounting profession where international standards and U.S. standards are being brought together as kind of one standard. So you'll see a continuation of that.
All right, well, great. Well, we're up against the clock. It's top of the hour. I want to thank Cathy Hyodo and Mike Schamberger of Grant Thornton for their time and their insight, sharing it with our audience. We very much appreciate that. We appreciate the very large turnout to listen to today's webcast, and we appreciate the many questions. I apologize that we could only get to a fraction of them, but thank you very much for submitting them. Some we will get back to you privately on specific questions. And please stay tuned to revenuerecognition.com and softrax.com for announcements of future webcasts. And again, I remind you that we very much want to hear your feedback on this webcast, and it's very important to us. If you look at your screen right now, you'll see the URL, feedback survey URL. And again, that's the way you get feedback to us, copies of the slides, and the Grant Thornton Survey of U.S. Business Leaders 12th Edition Report. Again, Cathy and Mike, thank you very much, and thank you all